When investors buy bonds, there can be a difference between the quoted price and the price paid. This lesson explains the difference through a study of a bond's flat price versus its full price. We also learn how to estimate the price and market discount rate of a bond in the absence of active trading through a process called matrix pricing. Let's get started. Recall this example in the previous lesson. We used the discount cash flow method to find the price of a bond based on its market discount rate. You would have noticed that in all the examples, we position the settlement dates on the coupon payment dates. This allows us to compute the discount rate or price based on whole periods. However, in reality, those trades are made in between coupon payment dates. For instance, if coupon payment dates are 1st of April and 1st of October, and we want to determine the price of the bond on the 1st of June, based on a market discount rate of 12.6%, how do we calculate its price? Before we do that, we should understand the difference between the full price of the bond and its flat price. If we consider the effect of coupons, we should see such a zigzag pattern on the price chart. As the coupons are paid to the bondholder, the coupon should no longer be factored into the price. This accounts for the sharp drop in price at every coupon payment date. This price is known as the full price or dirty price. This is the price an investor pays or receives when a trade is made, ignoring the effect of spread. The flat price or clean price, on the other hand, is quoted ignoring the effects of accrued interest. This is the price quoted by bond dealers. So in effect, the difference between the full price and the flat price is the accrued interest. For example, on the 1st of June, a bond dealer will quote the price of the bond at X dollars, which is its flat price. If a buyer wants it, she has to pay not just the quoted price, but also the accrued interest to the seller. This is because the buyer will receive the full coupon payment of $50 on the next payment date, which is the 1st of October, but rightfully, part of this payment belongs to the seller who held the bond for 2 out of the 6 months of this period. Let's learn how to calculate the full price, flat price, and the accrued interest of this bond if it was traded on the 1st of June. To calculate the full price of a bond, we first base it on the value of the bond on the last coupon date. Let's work this out together. At the end of the second year, there are 3 more years to maturity, which is 6 half years. We're working on a market discount rate of 12.6%, so half of that is 6.3%. Payment per period is $50, and the maturity value is $1,000. Solve for PV, and we get 936.67. This is the value of the bond 2 months before the 1st of June. To get the full price on the 1st of June, we have to adjust this value for the number of days since the 1st of April. To do that, we should count the number of days in this period, which is 183 days, and the number of days that has passed during this period, which is 61 days. The adjustment factor is 1 plus the market discount rate divided by the number of periods per year, to the power of the proportion of the period that has elapsed. Plug the figures in, and we get a full price of $955.94. The accrued interest since the last payment date can be calculated as the coupon payment times the proportion of the period that has elapsed. This works out to $16.67. The flat price is the difference between the full price and the accrued interest. This works out to $939.27. Note that the flat price is not the present value of the bond on its last coupon payment date. In this example, we use the actual number of days between coupon payments and the actual number of days between the last coupon date and the settlement date. This is called the actual method, which is used most often with government bonds. Another way to calculate this is to use the 3360 method, which is most often used for corporate bonds. This method assumes that there are 30 days in each month and 360 days in a year. So using the same example, we would calculate 2 times 30, which is 60 days, between 1st of April and 1st of June. Assuming 30 days per month, there are 180 days between the coupon dates. Let's work on an example using the 3360 method. A 5-year 8% semi-annual corporate bond was issued on the 13th of September 2015. It makes coupon payments on the 13th of March and 13th of September every year till maturity. On the 16th of May 2017, the dealer is preparing to quote its price, estimating that its latest market discount rate is 7%. How much should the quoted price be based on 3360 conventions? You may assume that the bid-ask spread is 0. Pause the video now to work out your answer. And we're back. Let's draw a timeline to help us visualize. The bond was issued on 13th of September 2015 and should mature on the 13th of September 2020. The dealer wants to quote on the 16th of May 2017. This date is 2 months and 3 days after the last coupon payment date on the 13th of March 2017. To count the number of days using the 3360 convention, we use 2 times 30 plus another 3 days. This is 63 days after the last coupon payment date. The number of days per period is 6 times 30, which is 180 days. The par value of the bond is not given, so we just go with bond conventions, which is to quote based on a par of 100. We're asked for the quoted price, which is the flat price of the bond. We first have to calculate the full price of the bond. To do that, we have to find the PV of the bond on the 13th of March 2017 using the market discount rate of 7%. There are 7 periods to maturity from this date. Interest per period is half the market discount rate, which is 3.5%. Payment per period is 4, and the future value is the par value of 100. Solve for PV, and we get 103.057. With this figure, we adjust it for the number of days since the last coupon payment date. We compound it by 3.5% for this period, giving us a full price of 104.305. Next, we calculate how much of this amount is the accrued interest component. Using the formula of coupon payment times the proportion, we get an accrued interest of 1.4. The quoted price is simply the flat price, which is the difference between the full price and the accrued interest. The dealer should quote the price as 102.905 on 16th of May 2017, based on a market discount rate of 7%. Thus far, our discussion has focused on the use of a bond's market price to calculate its yield to maturity, or reverse the process and apply a known or estimated market discount rate on a bond's future cash flows to calculate the value of a bond. What if we don't have either of them? This can happen in the case where the bond is not publicly or actively traded, or we're trying to price a new bond issue. In such situations, it's common to estimate the market discount rate and price based on the quote or flat prices of more frequently traded comparable bonds. These comparable bonds should have similar credit quality to the bond of interest. This estimation process is called matrix pricing. For example, an analyst wishes to determine the price of a bond which is not publicly traded. This bond has 4 years left to maturity, pays 9% fixed coupons semi-annually. What she can do is to find the market prices of a number of actively traded bonds that have similar credit quality. For example, if the bond has a credit rating of BBB, the comparable bonds should also have a credit rating of BBB. The next step is to determine the yield to maturity of these bonds based on their prices, coupon rates, and time to maturity. You should be familiar with this by now. Using the discounted cash flow method, we get a yield to maturity of 6.5% for bond A, 6.6% for bond B, 7.9% for bond C, and 7.7% for bond D. The key is to use the rates of comparable bonds to estimate the market discount rate for the bond we're interested in. As we know, the discount rate tends to increase with the time to maturity as there is a maturity risk premium. Our bond of interest has 4 years to maturity. None of these comparable bonds have 4 years to maturity, but we can use their yields to estimate its yield. One simple way is to use the interpolation method. We start with finding the average of the yields of bond A and bond B, which is 6.55%, and bond C and D, which is 7.8%. The difference between the two yields is 1.25%. Since the relationship is linear, the increase in yield for the 4-year over the 2-year should be 2/3 of 1.25%. The yield to maturity for bond X should therefore be 6.55% plus 2/3 of 1.25, which is 7.38%. Now that we have the market discount rate of the bond, we can apply it to its future cash flows to estimate the value of the bond. This should be very familiar by now. Number of periods is 8, as there are 8 more half-year periods to maturity. Interest per period is half the market discount rate that we've estimated. Payment is 4.5, half of the 9% coupon rate. And FV is the par value of 100. Solve for PV, we get minus 105.52. So according to the analyst, this non-publicly traded bond is valued at 105.52 using the matrix pricing method. So we've looked at one method to value bonds that are privately or not actively traded. Let's look at another method that is more often used for pricing new issuance. The principle is to get an estimate of the required yield spread over the benchmark rate. The benchmark rate is considered the risk-free rate, typically derived from the yield to maturity on a government bond having a similar time to maturity. The yield spread is the compensation required by investors for the additional credit risk, liquidity risk, and tax status of the bond relative to the government bond. Yield spreads are often stated in basis points. Both of these will be covered in detail in a later topic, so we shall explain them briefly here. At any time, there are government bonds trading with various times to maturity, so we can form a continuum known as the yield curve. For a particular issuer or issuers with similar credit quality, their bonds also trade at various times to maturity at various spreads above the yield curve. The basic concept is to get or estimate the benchmark rate that has the same time to maturity as the bond to be issued. This is followed by estimating the corresponding spread for that time to maturity. For both of them, we can simply use the interpolation method of the closest bonds. So for example, if a company wants to issue a bond of 10 years to maturity, we can estimate the benchmark yield as the midpoint between the yields of government bonds with 9 and 11 years to maturity. This works out to a benchmark yield of 3.2%. Likewise, we estimate the spread specific to this issuer based on similar bonds with 9 and 12 years to maturity. This works out to a yield spread of 2.9%. Adding up the two estimated yields, we have an estimated discount rate of 6.1% for this new issue. The issuer may want to set the coupon rate at 6% and sell the bond at a discount. Let's apply this concept. A company wishes to issue a 7-year BB-rated and corporate bond in the US. To appropriately price the issue, the underwriter collected the following information from the US bond market. What's an appropriate estimate of the market discount rate to price the bond at? Use the yield spread plus benchmark rate method. Pause the video now and work out your answer. And we're back. Let's first find the benchmark yield. We have a 5-year UST bond at 2.44% and an 8-year UST bond at 2.82%. Interpolating for the yield for 7 years' time to maturity, we get a benchmark yield of 2.69%. The next step is to estimate the spread. We first calculate the spreads for the 5-year and 8-year BB bonds. We do this by subtracting the yield of the UST bond from their yields. So we have a 5-year BB bond with a spread of 6.84% and an 8-year BB bond with a spread of 8.36%. Again, interpolating between the two, we estimate that the spread of a BB bond with 7 years to maturity is 7.85%. The market discount rate of the new bond issue is simply the sum of the benchmark rate for 7 years and the spread of a BB bond for 7 years. Adding the two, we get an answer of 10.54%. And that concludes this lesson on quotes and calculations for bond prices. In our next lesson, we shall discuss the differences in yield measures for fixed-rate bonds, floating-rate notes, and money market instruments. See you soon!